I'm a bit daunted standing up in front of you guys, because who's been in this industry for more than 4 months? If you could give me a show of hands. So those who haven't got their hands up, you're probably in the conference next door, but this one might be more interesting. So yeah, it's a bit daunting because you guys are certainly more experienced than me, and I'm sure know a lot more than I do. So this will be a presentation of first impressions, very much so, and perspectives. And hopefully some things will resonate with you. Hopefully you might disagree with some of the things I say as well. So let's get going. This is, before we go to the future, let's look at the past. So this is the last sort of 5 years of this market, focused on the retail side, but if I showed you fleet-based lending, it would show a similar trend. And I have to say, coming into this industry, wow, 12 billion to 28 billion of point-of-sale finance in 5 years. You won't find any other financial services market that has grown like that in that time period. It is phenomenal, absolutely phenomenal. So my first prediction, which I think will be very accurate, is we will not achieve the same level of growth in the next 5 years. But coming into the market, I was really blown away by this, obviously driven by a couple of things. Obviously, post-crisis, a lot of pent-up demand being released, lots of supply and support into retail car registrations, new and feeding into used, and then this thing called PCP, which I think has really revolutionized the way customers are funding cars. The stories I hear of people going in, wanting a used car, or even wanting to pay cash and walking out with finance because PCP is so straightforward and removes the need to put so much capital down. That's fairly commonplace in this market. And it brings lots of issues for us going forwards as well as opportunity. But this is a real transformation in quite a short space of time in this market. And I think when you look at what the industry's gone through and adapted to over the period, I have to say I'm very impressed with the way the market can deal with change. If you look at some of the stats on there, not just car penetration, but some of the technology-driven stats, such as CO2 emissions, the fact that you've gone through a massive change in regulation in auto finance at the same time. A lot of things here have been accommodated, dealt with, alongside growing a market. And again, first impressions, I find that quite impressive, the ability of this market to adapt to change. And as I've gone out to dealer groups in particular and intermediaries, I'm always impressed by the very entrepreneurial nature of the people who run those businesses. So, on one hand, it doesn't surprise me, but rapid growth and rapid change, can bring a lot of consequences to it as well. So I think if we look back, I would say there's lots of confidence in this market, or confidence we should take when we look forward, because this is a market that does change pretty well. Digital. You'll all know about digital. We can't avoid digital. It's in our lives every day. The digital shift, as I see auto finance, I think we're actually just at the foothills of digital in this market, in this industry. This is an example of one that we'll all be more familiar with and is maybe more mature, which is how people buy, own music, media, video, all those kind of formats. And you see, how customer adoption changes as propositions come through the maturity curve, and how those who sort of bury their head in the sands basically disappear. You've seen that to Blockbuster, you've seen it to HMV, you've seen it to the sort of Virgin Megastore concept. Could this happen in auto finance? I think that's an open question. I don't know. I don't think it will, and I'll maybe explain more as we go through. But what it does tell me, what this example tells me in particular, is what's behind this actually is a societal shift from owning something to renting it. And that's what's behind that when you draw it back to its brass tacks. And I think that's happening in many markets. And if we look at this market, at the auto market and the auto finance market, I'm not trying to, by the way, say that nothing happened between 1970 and 2000, but But just to sort of draw your eye to what's happened in just the last 5 years, there's been an explosion in, led by technology and digital in the way customers might adopt to using cars rather than owning cars. You know, people who live, work, and never leave London. I'm not one of them. I live in North Wales. I like my car. But I have friends who live, work, and kind of stay in London. They don't own a car. In fact, they're abhorrent by the thought of owning a car because they've got nowhere to park it. And when they drive it, they're doing 8 miles an hour. So they'll use Zipcar or one of the others. You know, it's so easy. If you don't know how easy it is, go onto Zipcar. They've got a 45-second video that shows you just how easy it is to go and use a car. Now, it all sounds great. Zipcar have got something like 3,000 units in the UK. You know, we've got over 20 million vehicles on the road, so you've got to put these things into perspective. However, certainly where people are living, working, and staying in large conurbations, these things will, I think, quickly become the norm. And as users get to experience them and get to say, actually, I quite like this, and it's not that expensive, I pay as I go, you know, why wouldn't this proliferate further? Now, that has implications then on car finance, certainly. It might even shift the market more from a retail to a non-retail market when it comes to financing. You know, there's still cars being used, but how they're used and owned, and therefore how they're financed, could shift quite dramatically on us. And then in car finance itself, I've also seen an explosion in digital adopters trying to break the cycle of buying cars versus buying car finance. You know, there's been a lot of press on this. There's loads of brands in the market. All you need to do is spend 20 minutes on Google, and you'll get a list of 20 players in this market. They've not really broken through in any great way, though. You know, it's still dominated by that buying experience through an intermediary, and certainly as Black Horse, we're still committed to that model. I personally, even after first impressions, believe that model will sustain as long as intermediaries stay relevant to consumers. And they have to therefore digitize themselves, and we have to go alongside it. But fundamentally, I don't believe that most consumers will divorce car buying from car finance buying as long as that experience works well for them. Not many people wake up and say, I want to buy car finance. So in our industry, we're already seeing a lot of innovation. I think we've got lots and lots of change to come. You know, where we are on the adoption curve and these new propositions, I don't know. You know, this is a kind of a figurative sense and nothing more than that. But we are seeing lots of trends that I think are going to shape it. You know, ownership and usership, I think, are going to have a big shift. You know, I've got 2 daughters, 8 and 14. At the moment, all they tell me is the car that they want to drive. I think they're assuming I'll buy it. But it's quite interesting as I think about as they come into the car market or come into the place where they're going to need transport, how are they going to think about it in 5 or 10 years' time? And I think, you know, that little picture on the right, I don't know if anybody's seen Google Car. Fascinating concept. I actually saw a video. I was with a tech consulting firm on Monday, which was a great thing. It was learning about how to demystify the digital world. In fact, they demystified it so much that by the end of the day, I had built my own website using HTML, JavaScript, and CSS coding. Okay. I haven't got a clue about any of those things, but by the end of the day, I'd built a website, which means my IT department's in for a lot of trouble the next time they give me an estimate, because I know how easy it can be. But one of the things they showed us was a video of a Google car going along a street and being met with an old lady in an electric wheelchair chasing a duck across the street with a broom. Because that's the sort of thing that if you're designing a Google car, you have to figure out how to deal with. The point was that there are millions and billions of permutations of what happens on a road every day that the human mind kind of deals with, that it's very hard to program, even if you've done 1 million miles of motoring, which is what Google did to create the first Google car, the first driverless car. And in the face of that, what a Google car does is it just stops. It does not compute. I'm just going to stop. So whether we'll ever get to Google car, I don't know. And I guess none of us know. It's a fascinating concept, and I'm sure a bit like, the kind of conurbation debate, how cars get used in inner cities versus how they get used outside. Maybe it will have a place where we all be driving Google cars and sitting there reading our newspaper or doing our work on our laptop. I don't know. At some point, there's going to be human input required. But it's fascinating to watch that unfold. And I think, as I said, digital is disrupting business models. A lot of digital, I think, personally, has just disrupted the user experience. And behind that, the model hasn't really changed. And maybe that's the trend that we'll see in our markets. So, if you can make the user experience so much more convenient or easy for the user, the underlying model might be exactly the same. But time will tell. Another area of revolution is fuel technology, which has obviously been brought into very, very strong focus in the last couple of months by events that have compounded VW Group. A couple of things I'd say about this. There's a great connection here with PCP. There's probably 8+ million diesel cars on the road. If half of them bought in the last 3 years are diesel, which is roughly, and most of them have been financed, and most have been financed on PCP, you've got millions of vehicles out there with a residual value sitting on them. And the trend you'll see on PCP RVs, driven by manufacturers, is to put the residual value as high as possible, as close to that sort of future guaranteed value, as close to the future residual value as possible. That means if there's a shock, it gives us a problem. It gives the person who's got the residual value risk sitting on their balance sheet a problem, but it also gives the consumer a problem, because they'll no longer be walking back with some equity in their vehicle. So when they come to buy the next vehicle and they've got no money to put in for a deposit, what happens to the market? So I think there's much broader ramifications to this phenomena than necessarily meets the eye. The one thing I would personally like to see, if I drew that diesel line all the way back to when it was, let's say, sub 10%, the adoption of diesel has been over 20, 25 years. I think it would be responsible to see an adoption of any further technology over a similar time frame, because then everybody gets the chance to adopt in a measured, controlled, responsible way, in a way that doesn't cause a lot of chaos in the market. We have to be careful about dislocation here. So, fuel technology is going to have a role to play, also has a role to play in finance when you're the one trying to price the business, and also if you're the one sitting with that on your balance sheet. So let's move a little bit to auto finance and what are the sorts of things I think could happen, and sort of try and draw a few of those things together. And I've brought it into three: research, the pre-buy stage, buying and owning, and the revolving. So on the research stage, I think it's pretty obvious that most customers use digital. They will do a lot of research, often will be more informed than the dealer or the salesperson when they go in and buy the car, or often even know what it is they want before they physically step near a showroom. So that part, I think, has already changed massively. I think we'll see a lot more of the basic processes just clear out the clutter, like the application process, the credit process. Some of that happens already today. We invest quite heavily in that as an organization, and I want to do more, because it kind of gets in the way, actually, of the thing that you really want to do when you're in a showroom, which is, talk to someone, experience the thing that you're going to buy. So I think lots of basic things can be done to just improve that car buying process without necessarily fundamentally breaking it, or changing it. When you come to buying and owning, I guess a lot of this for me will revolve around: do customers really own, or do they use? You could argue that most customers don't actually own their vehicles. They probably haven't figured that out yet, because maybe haven't really figured out what PCP means, but that in effect is what it means. You don't really own the vehicle anymore. But things like rolling credit products, I think, are quite an interesting thing to think about. So, you have a line of credit in the same way maybe a business would have that you might reevaluate from time to time, but it allows you to convert from car A to car B to car C in a much more seamless way. At the moment, every time you switch, it's like a new customer going into a new transaction. And why do you need to do that? So that is quite an interesting phenomena for me, and alongside that obviously comes rolling credit. And then in the owning phase, self-service will just be normal. People being able to service their own contracts and terms and conditions. And I think the other thing that's part of that contract is what else the customer's buying when they're buying the car. Any given package on a car now will have maybe 6 different features to it, but you tend to see lots of different contracts for all the features. That's not really designing things from the customer's point of view. So I think the ability to sort of plug and play with options in the way you would with other services has got to become more relevant here. And that revolving to new finance. I mean, optimizing when to sell, when to move your car on, particularly if you're in a PCP style contract. I mean, I think as an industry we're really poor at this actually. Lots of potential here. Integrated offerings to help drive that kind of activity, and the integration of data, CRM, and customer contact. And when you kind of fold in the sorts of things you could get from connected car technology or telematics, really the harnessing of that data to provide relevant offers back to customers, I think could be quite powerful. So I see that as a real area of opportunity for the market. And so I'll move on to data and just talk about that. I hear lots of discussions. In fact, I was at a great Grant Thornton hosted event about a month ago where we had quite a lot of conversation about who owns the data. Is it the manufacturer through the connected car technology and the telematics? Is it the dealer because it's their customer and that's where they go to the servicing? Is it the lender because they've effectively got the balance sheet risk and the cost sitting on their balance sheet? My personal view is none of them do. The only person that owns the data is the customer. And if you look at how regulation is changing in Europe and in the UK, that's really what it's driving to. You see banking being forced to open up data on customers. And the essence of that is there's lots and lots of data out there about all of us. You've just heard the Google stat. Ultimately, it's about customers owning their own data and giving people permission to use it. And you get permission to use it if you use it in a way that helps me. And I think in owning data and using data, there's a bit of a tightrope that we're going to have to walk. And for me, there's a cultural point about the industry and how it chooses to use data. It needs to use it in the interest of consumers. And get that focus and get that right. If it uses it to exploit consumers, it won't have that right for very long, or that power. It will be removed either by the consumer or by the regulators. But I think there's loads of opportunity in the responsible use of data. And I think what's going to come to the fore is the people who've got the ability to amalgamate and combine lots of different types of information, package that up and pass it back to the consumer in a relevant way. So who will win? I've got no idea who will win on that. It could well be a Google, who fundamentally are a data processing business. If you look at the scale of their data storage and data computing power, it is just phenomenal. It's quite scary. But then, do I think Google wants to kind of come and dominate the auto market or even the auto finance market? No, I really don't think that they do. I don't think that's their market, and what Google are very good at is knowing what they're good at. However, they could come and use a lot of those sorts of services and technologies to support us. So, you see the likes of Google doing a lot more work to try and, for example, partner with financial services organizations in the UK and globally. And that's really a recognition to say, if we combine, if we come together, if we bring our data and our analytics. Actually, a bank's data is richer still than Google's because of the depth of personalization in it. Google has lots of information, but it's not personal. Then that could be quite powerful. From data, I want to move to regulation. The FCA coming in to regulate auto finance has been a huge shift for this market. I think it's adopted it quite well so far, but I also think we're only at the end of the beginning. And having worked in markets that are heavily regulated for the last 15 years in insurance, in long-term savings, I have a good sense of what regulation can do to markets. But there isn't one regulator that we have to think about. There's four, actually, because all four of these are having an influence on our markets right now. The obvious one is the FCA and CCR2. The interesting thing for me is the FCA is actually only interested in the bit it's regulating, which is finance and insurance. What I find quite interesting in the auto market are the business models where you effectively don't make any money on selling the product, i.e. the metal, and you kind of make the money around the edges on all of these. If you look at it in the round, it looks reasonable, because I haven't found any dealer who's making more than sort of 3-4% margin. So no one can be accused of profiteering in that market. The problem is the FCA won't care about that. They'll only care about what you're making on the finance and insurance. And I don't think the industry's necessarily woken up to that point yet. If I move to the FOS, the Finance Ombudsman is a separate entity. Its focus at the moment in things like merchandisable quality disputes and the impact of law onto that with the Consumer Rights Act is fascinating. But the FOS have clear rules that go way beyond what the FCA would say. So you have to look at that as well. If if you don't understand the picture in the middle, that's the Prudential Regulatory Authority. Anybody who lends money, anybody who considers themselves a finance business, you have to be governed by these guys as well. They're interested in capital and liquidity, and obviously since the financial crisis, they have emerged as an entity in that. In my old life, I would deal with all of these entities, and the PRA is effectively interested in, are you sound? And I'll come back to that point in a moment. And then you've got the law courts. Has anybody heard of Plevin? Or rather, has anybody, hands up, who has not heard of Plevin? Okay, there's a few. Plevin is a case, actually, that's rooted in PPI, but it's not really about PPI. Plevin is a case that says, if the level of commission in a contract was so high that had the customer known about that level of commission, they might not have entered into the contract, then the contract's null and void. Okay? That can apply to any contract where commission is present. Almost every single consumer contract in auto finance has commission present. So Plevin affects almost every financial services market. The FCA hasn't even figured out yet what to do about Plevin. But that could be huge. So here we all are focusing on CCR2 and the FCA. One of the biggest things to hit us in the next 2 years might not even come from the FCA, or might actually come from the FCA, but via the law court. So you have to think about that as well. So 4 regulators. That's a lot of oversight, and we need to be collectively across them all. And I'll talk about the FCA a little bit. As I said, I think this industry has done pretty well with the adoption of CCR. But underneath this is where the FCA is coming from. You can think about regulation as rules. Tell me what's right and tell me what's wrong. And I'll just sort of do that, and then I'll carry on with my job. Yeah? Or you can think about regulation in terms of principles. And the regulator, the FCA, is all about the latter, of course. They've actually come from a world of rules, but they're in a world of principles. Which is, if I have to tell you everything that's right and wrong, then we're knackered. We're in deep trouble, because it means you don't have the right conscience at the heart of your organization that's driving the right outcomes every day. That's what the regulator is getting at. And that's why I think with CCR we're at the end of the beginning. What I see in going out across the market so far is a lot of businesses actually are more on the outcome focus end. And I think the regulator is looking at this market as a market that's got low customer detriment risk in it. versus other financial services markets. So we're sort of starting from a good place, but we lose that at our absolute peril. And there are parts of the market still who are refusing to adopt this approach and are focused on, tell me the rules, or if the rule doesn't exactly tell me to do that, then I won't do it. Even if I think about it from a customer outcome point of view, I'd very quickly get to the conclusion that it's wrong. And a few examples. DIC, has anybody not heard of DIC, Different in Charges Commission? Okay, I assume you know what I'm talking about then. I find this quite fascinating when I came to the market. So, you know, the kind of old world way of doing things where, you know, you can kind of charge a customer a certain amount and then you can actually charge them a bit more and get paid more. Well, there's no bias in that, is there? There's no potential for customer detriment in that model, is there? Well, of course there is. But I still have some of my peers in the market who are prepared to operate with that model. And I find that ridiculous. I really do. You know, Black Horse has made a clear stance on that before I even joined. I think it's the right stance. We deal with over 4,000 dealers and dealer groups through the UK. As at now, I have one that's unwilling to change. And by the end of next week, I'll terminate with them. Because that model cannot exist. The thing that worries me is the few percent in the market who are willing to carry on risk the reputation of the whole of the market. So I think as an industry, we have to decide that things are wrong and to stop and to move on and frankly, wake up and smell the coffee on certain things. And for me, DIC is one of them. But collectively, if we focus on outcomes and principles, we will steer the right course. We will maintain that reputation of actually, we're doing collectively the right thing by consumers. There's low risk of customer detriment in this market. And then I came across this last week, which isn't about auto finance, it's about auto manufacturers. It's an article from the FT, and what it shows is just what a bunch of manufacturers, it could be any manufacturers because they all look very similar here, what they claimed was their laboratory CO2 emissions back in 2001 and the gap between what was really there. So you can see it's about 10%, less than 10%. And then in 2014, what the gap was between lab and real world. Now, real world is arguably, you know, more complex versus lab these days. But you see the shift. Now, how do you look at that? Now, one way you could look at that is to say, well, everybody's playing by the same rules, because they are, you know, and no manufacturer is dictating the tests. Consumers must be aware of this, and when they get to drive their car, they know what their emissions are anyway, and they know what their they certainly know what their fuel economy is, even if they don't know what their emissions are. Or you could look at that and say, this industry is playing with consumer trust on a massive scale. You could say, we're abusing the trust of our customers, but the fact that everybody's doing it makes it even more worrying. Coming from a bank and a banking industry and an insurance industry, I have a lot of experience growing up in my career of dealing with mistakes of the past. It's horrible, it's painful, it's not particularly rewarding to do those sorts of things. I really fear that we're in a market that's risking consumer trust on a market level. So I'll leave that thought with you. Now, what needs to change, of course, is the regulations. But what it seems to me is that everybody's just going along saying, well, it's not my job, so I'll just abide by the rules that exist. But this has to change. This has to change. I'll move and I'll finish on auto finance. So a couple of slides. Whose balance sheet is there anyway behind lending? There has to be a balance sheet. This is two things. One is CDS, credit default swap spreads. It's a measure of the riskiness of giving money to a company. You see the spreads of a number of UK banks and a number of auto manufacturers. Interestingly, a number of the manufacturers used to have CDS spreads lower than banks, which reflects banks coming out of a crisis, recapitalizing, et cetera, et cetera. You see what's happened in Q3 with the recent crises that's hit the press. Interestingly, the company whose spread has widened the most is not the one in question. And I'm not here to pick on any individual firm, but you see the trend there. That effectively affects your cost of money, and the other thing that affects your cost of money is, of course, your credit rating and what happens. Now, what's interesting to me is what happens when a manufacturer comes under stress. When they come under stress, their balance sheet comes under stress. If a manufacturer has effectively become a bank, but it's not taking deposits, or it's taking deposits far fewer than it's lending, it has what's called a funding gap. If you lend 10 billion, you've only got 2 billion of cash or deposits, you've got to fund the other 8. You fund the other 8 by selling your assets in the market through securitization or getting wholesale money on overnight rates. You need liquidity, not capital, you need liquidity. When a manufacturer is under stress, the thing that gets really expensive really quickly is liquidity. This worries me, and the reason it worries me is this. 65% of all UK car lending today is through captives. It's not through banks. It's through car companies who are being banks. I think we've got a systemic risk in the market because of this. Now, the banks went through their own crisis 10 years ago, or 8 years ago, and that actually affected the money supply to this market. So you can kind of understand where this all started from. But the banks these days are in a fundamentally different place. They're better capitalized, much more heavily regulated, and the ratio of what they lend to their deposits is very, very narrow. In fact, in some banks, it's even positive, but it's very close to zero. So, I have a hypothesis. I would say this, wouldn't I, given my position, but I think bank-based finance companies are essential to the auto finance market because you need that liquidity and you need that capital behind this market. And given the customer reliance on lending that's been driven in the last 5 years, it's probably more important than it's ever been. So I'll leave you with that. But 3/4 of new cars sold reliant on car finance. PCP and contract hire, which have got a structural exposure to RV, that needs tightly managing. That's a risk business. And the additional cost every time you increase your funding cost by 1% is pretty high on a 10 grand car loan. So that's all I want to say. Hopefully that's given you some things to think about, some food for thought, which was the purpose. My closing remarks are really 4 things. And I think one of these was certainly highlighted at the first keynote on the first conference 2 years ago. But customer needs have to sit at the heart of an industry that's going to be successful. I've seen loads of positives coming into this industry of where that happens, but it needs to continue to evolve. We're not there yet. And I see an industry that does have trust. It has trust of regulators and trust of customers, but we are risking it, and we have to stop doing that. I see digital disrupting in lots and lots of ways, but I still fundamentally see cars and car finance as deeply connected and ever present, as long as we make it relevant to consumers. And I see strength in independent lenders and independent intermediaries. I think those 2 things will be at the heart of a healthy industry going forward. Thank you very much.
Thank you. Richard, would you?